All right. Today is Tuesday, December 13. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. What a day, what a day, what a day it was.
A lot of pies.
We were in the green, CPI is down, inflation is over. The bottom is here, new all-time highs by the end of the year. It's the Santa rally, it's Christmas after all. But you forgot that Christmas has the green side and the red side. And Santa, well, he likes them red. Just take a look at his suit, it's red, it's not green. So when people talk about the Santa rally, I'm like, what are you talking about? Santa is going to deliver the bags. And today, all of this CPI euphoria with the massive rally right away, well, it all faded, and the Dow at some point lost almost 800 points worth of gains, and it went down negative. So what happened today? Before we talk about that, let me tell you a story. I've been traveling all over the country for the last couple of days or so, and I just came back, matter of fact. But today in the morning, I was watching the business news in anticipation of the CPI. And I happen to be an early riser, specifically when we have an important catalyst such as the CPI. So I was up at around 4 in the morning. And remember, throughout this program, I've been saying this over and over and over again. Matter of fact, I talked about it in the members only program on Sunday and again last night. The problem with this market is the fact that it is pricing in a fantasy. The market is pricing in interest rate cuts. It used to be excited about moving down from 75 basis points to 50. But we've been sitting on that for a while now. It's been baked in the cake for a while now. But the market has been rallying in anticipation that the Fed is going to start cutting rates as soon as Q2 of 2023, which is absolutely delusional. Last time around, JP said that it is too premature to talk about a pause, let alone interest rate cuts. Yet the market, the algos, the participants continue to doubt the Fed. And I don't blame them, to be completely honest, because the Fed has a lack of credibility problem. But this is yet again fighting the Fed, which is a dumb strategy. And the problem is, even if we have a rally in the aftermath of the CPI, because inflation is going down, the problem is the market is now pricing in interest rate cuts. It is way ahead of itself, and Jerome Powell has to put a stop to that, because this kind of thinking is dangerous, and it's going to make the Fed's job a lot harder. So if you watched last night's program and you heard me say that, hey, my expectations are the market is going to consolidate all the way till the FOMC is out of the way. However, if the market overreacts to a tame reading by the CPI and shoots up higher, I said that would be music to the ears of bears, because that would be a slam dunk short right away. Easy money. Specifically if it happens before the FOMC. It doesn't make sense at all. For all we know, Jerome Powell could come out tomorrow and initiate a rally in the stock market by being dovish or saying something. But rallying by the tune of 4%, at least in the NASDAQ this morning, before Jerome Powell even speaks, that is delusional, that is stupid, and that was a gift to short right away, at least for the day. In, out, hello, goodbye. Easy money. You buy the puts in the morning and you close them by the end of the day. In, out, hello, goodbye. But in the morning, since everybody knows that I'm bearish and I say that the Fed's job is not done yet, even the Fed is underestimating how high rates have to go to tackle inflation down. So when the CPI came out, we saw the insane market reaction right away, which, by the way, was done by algos. No human being is going to act this stupid. Or maybe, I don't know, because I've been texting my colleagues, and they said, hey, at some point you got to capitulate. At some point, you gotta stop being too bearish. They tell me that my bearishness is clouding my judgment. And at some point, I have to realize that inflation is going down while the job market remains intact. And therefore, we're gonna have a soft landing. And today's CPI was a confirmation that we should buy. So I said, okay, what are you guys doing? What are you guys buying? Are you guys gonna buy right away? And they kept floating a bunch of names. Oh, we're buying this, we're buying that. And I just had a little smirk on my face, did not respond at all. I stayed silent for the majority of the day. And while they were thinking about buying stuff, I was thinking about shorting stuff. And as the CPI rally was ongoing in the futures market, pre-market, I was writing a bunch of names. And I came up with the Qs, Apple, and RKK. I'm going to buy puts right away, at the open, right away, because this is a gift. This massive gap is going to end up in a crap, because who the hell is going to buy? Well, we know that Jerome Powell is coming tomorrow. It doesn't make sense at all to any rational human being. And immediately, as the stock market started trading, the human being used the pump to dump and book profits right away, or maybe book losses. Now, a lot of folks shorted right away, including me. And these put options in the Qs, for example, by the end of the day, were up by over 200%. The puts on RKK were up by almost 400%. Cha-ching. In, out, hello, goodbye. You make this kind of money, we call them steak and lobster kind of trades. You book your profits, you thank the Lord, you take your wife, your husband to dinner, steak and lobster. While you're at it, you might as well invite the mistress, the mister. Let it out there. Be bold. You're on the top of the world right now. Take a shot. JFK did. And by the way, I'm not a marriage counselor, so don't take my word for it. You invite your mistress, your mister, along with your spouse, you get divorced, that's not my problem. But anyways, we have a lot to talk about. So let's not waste any more time, and here it is. In focus tonight. How about the CPpie? Because we got a lot of pies all over the place. You see, right away in the morning when we got the CPI report, the market shot significantly higher. And everybody said, oh, inflation is dead. That's it. It's over. We got the confirmation now. Meanwhile, the reading of the CPI, aka the CPI, and this is the cooked version, mind you, with the seasonal adjustments all over the place to downplay the inflation in medical services, for example. With all of that, the CPI month over month was actually positive by 0.1%, meaning inflation, all in all, still going higher. But that doesn't matter to the perma bulls and the perma pumpers on Wall Street because they came out hailing the first really meaningful beat on inflation. Bring on the relief rally, they said. And the data should put a lid on the Fed's terminal rate. It's over. It's gone. Inflation is dead. Here's another antique who says the CPI justifies the market's exuberance this time. Oh, really? The market that is pricing in interest rate cuts? What the hell is wrong with you? And I say calling inflation over and rate hikes not needed anymore is beyond delusional. It is like when I was a kid. I used to tell my mom that I finished my homework after answering 2 out of 25 questions. Mission accomplished, homework is over. Meanwhile, I got, 23 questions left? This is exactly what the folks are doing right now who say, oh, the Fed has to pause, to pivot, to cut rates. Why? Because inflation went down from 9% to 7%. Remember, it has to go down all the way to 2% before the job is done. And we still have plenty of tailwinds intact for inflation to pop higher again the moment the Fed eases. But the most important take, and you're going to see the markets succumbing to this reality sooner than later. For now, the CPI all in all went down to 7.1%. And what the perma pumpers and the perma bulls are saying, hey, the Fed doesn't need to do any more rate hikes because we have a lag effect from the rate hikes that they've already done. And what's going to happen is inflation is going to crash right away all the way down to 2%. Just like that, due to the lag impacts, and somehow the economy is going to remain intact. And I say the problem with this fantasy is if inflation goes down all the way to this magnitude, this fast to 2%, it means that we have an economic disaster. It's not good deflation. It's bad deflation. It's deflation happening because we have a recession going on, and perhaps a severe recession. So be careful what you wish for. You say buy stocks because inflation is going to go down. Well, it's going to go down, duh, but it's going to go down for the wrong reasons. Among them, inflation. You say buy stocks because the Fed is about to cut rates. Well, the Fed, if it does cut rates to begin with, they will do for the wrong reasons. Because the economy is too weak. Because the economy is crashing. It will be a mission of mercy. But again, the delusion goes on. And I say, how long will it take before the market realizes that nobody gives a crap anymore about inflation coming down? If the Fed continues on the path, of course inflation is going to come down. But at what cost? From now on, it's going to be all about the recession creeping up, not inflation going down. It is a substitution going on here. Inflation goes down, recession goes up. And the market is going to start to concentrate about the recession creeping up. And it's not going to be excited anymore by inflation going down. It's just a matter of when. When is that going to happen? And my hunch is it's going to happen as soon as next year, perhaps in Q1, Q2 max. And yes, you might see inflation trending down, but the market is not going to respond by rallying higher. Yes, you might see the 10-year yield going down, yet the market going down along with it because inflation is going down, yields are going down, in expectations of a recession. The bulls can't win. This is the problem. And they haven't come to this realization yet. Matter of fact, the bulls continue to move from one fantasy to another. First, transitory inflation, then peak inflation, then pivot, then soft landing, then rate cuts. Soon enough, when they realize that none of this will happen, their next fantasy will be, oh, the Fed inflation target will move up from 2% to 5%. This is desperation, this is stupidity, and this is why all of these dumb rallies that have been going on, they continue to get crushed right away. by reality, by the facts. And here's the problem, folks. You can say that inflation went down all you want, but this is the inflation rate in 2022 alone. You can say that fuel oil is down month over month. Hence, inflation is over. The problem is, fuel oil is up over 80% in price this year alone. Eggs up almost 60%. Airfares up almost 50%. Vegetables, fruits, vehicle repair. This is severe inflation that has been going on since the beginning of the year. And to take this inflation down, it will require a lot of damage to the economy. It will require a lot of work by the Fed in tightening the monetary policy. But to say that, oh, the process of inflation has slowed down or stopped, and hence mission accomplished, and the Fed has to cut rates, that is absolutely stupid. And it is stupid because the job is not done. This kind of inflation will cause permanent damage. The government can say, hey, inflation is going down. But is your landlord showing up and saying, hey, by the way, the CPI went down, so I'm going to reduce your rent? That's not going to happen. You're locked in a year lease. If you're spending more at the grocery store, that is eating away from your budget to spend on other things and stimulate the economy. And the economy ends up being in stagnation. So this fantasy about a soft landing that's going to happen magically somehow, the damage is already done. It's too late for a soft landing now. Either the Fed is going to crash the economy right away by being aggressive, and they will crush inflation by inducing a recession, or they can play this dance and slow down because inflation is slowing down, and then risk inflation going higher again, and the Fed will have to come back and act more aggressive at a time when the economy is going to be a lot weaker than it is right now. And hence, the economy's ability to handle interest rate hikes at that time will be a lot weaker than it is right now. And by the way, when you say that inflation is going down, look at the Atlanta Fed's sticky CPI. It is actually moving higher. And this is the kind of stuff that the Fed looks at. So when you say mission accomplished, higher we go, you have absolutely no clue what you're talking about. And here's the problem, illustrated once again. When you look at this chart, we can see the market expectations on how high interest rates will go, when they're going to peak, and when interest rate cuts are going to happen. Now, pre the CPI, as you can see in pink, the expectations were that we have another 110 basis points to go, meaning 50, perhaps another 50 or 225s, and that will be it. And rates are going to peak at around March 2023, and then we see interest rate cuts by the summer of 2023. After the release of the CPI, the market is now pricing in less interest rate hikes and pricing in interest rate cuts as soon as Q2 2023. Even though the Fed's dot plot, which is by the way still out of touch with reality, but even the dot plots say that the terminal rate will be much higher than the market is anticipating. And most importantly, interest rate cuts are not going to happen until rates peak at around 2024, and the cuts will happen right after that. So the market is way ahead of itself right now, and there has to be a readjustment. How do you do that? Well, the market has to price in that the Fed is not going to cut rates as soon as 2023, and the peak rate will be a lot higher for longer, meaning this is the job of the chairman of the Fed tomorrow, is to readjust and realign market expectations with reality. That folks, if you think this is over, it's not over yet, and there is a lot more pain to come. We need to see more pain in the equities market for all of these out-of-touch expectations to be readjusted. And there was also an important finding in the CPI today. I tweeted this. I said, by the way, the CPI today was proof that the economy is in stagflation, not deflation and soft landing. The devil is always in the details. What am I talking about here? Well, let's bring back a segment we call Think About What You Think About.
Think about what you think about. Think about what you think about.
And when the Wall Streeters say that inflation is gone, it's over, and it's going down, the average American looks around and says, what are you talking about? I mean, look at the month-over-month inflation rate in food. We're talking, once again, month-over-month. And I know that certain items went down month-over-month, but a lot of items continue to see higher inflation. Inflation going higher month-over-month by a lot. These are important categories. So again, think about what you think about when you say that inflation has peaked and inflation is gone, when the consumer is paying 8.9% more for lettuce month over month, when the consumer is paying over 3.2% month over month for apples and paying 2.6% month over month more for tomatoes. Think about what you think about when the consumer is paying 2.3% more month over month for fruits and eggs, and 2% more for instant coffee, 2% more for ice cream, 2% more for white bread. I'm paying 1.9% more month over month for crackers, 1.5% more for cookies. Same goes for flour, 1.2% more month over month for vegetables, 1% more month over month for milk and dairy. Think about what you think about when you say that inflation is over. What are you talking about here? And all of this inflation from food takes away the consumer spending power on other things. So it's no wonder why we're seeing airfare ticket prices going down. It's not because we're seeing a soft landing and good deflation. It's because the consumer is spending more at the grocery store so they cannot travel anymore like they used to. No wonder why airfare tickets are down. They're down for the wrong reasons. As a matter of fact, JetBlue came out today warning that revenue levels are going down for airlines across the board. Why is this happening? The demand is being damaged. So again, when you say that the CPI is saying we're seeing good deflation in the economy and soft landing coming, you're denying the facts. You have no clue what you're talking about. You got food inflation moving higher for a lot of categories, combined with bad deflation in airline ticket, for example, because the demand is getting crushed. This is stagflationary. Higher inflation in certain categories, perhaps the most important categories, and deflation in certain categories because demand is getting crushed and diverted to other categories. This is stagflation. This is not a good report. This report shows that inflation is still sticky, and it's not going to go down to the Fed's target of 2% without a massive fight and a lot of damage. So again, am I surprised by the insane reaction by the market in the aftermath of the CPI? Not really. Am I surprised by the gap and crap, the pump and dump that took place today? Not really. It all makes sense. It was an overreaction by the algos, and the human being came out and said, you know what? We're taking profits, perhaps shorting a little more, because nobody knows what's going to happen for sure until JP is already out of the picture. And that's happening tomorrow. So rallying beforehand doesn't make sense at all. And today was the opportunity to buy these puts, close them the same day, and then wait for Jerome Powell to get out of the picture and see what happens. But in reality, when we talk about market expectations pricing in interest rate cuts, what do you think Jerome Powell is going to do tomorrow? He's going to come out cracking the whip, saying, yes, I'm doing 50 basis points this time around, but don't get too excited. The terminal rate might go even higher than anybody anticipates, and the market needs to price that in. In other words, yes, market, you got the 50 basis points, we're slowing down the pace, but you got to go down too. You got to go down and price in what's going to happen in this economy. And what's going to happen in this economy, frankly speaking, the Fed is not going to tell you that, but they know that the only way to defeat inflation effectively is, number one, to create higher unemployment because that reduces the demand tremendously in the economy. And number two, they can achieve defeating inflation by crashing the stock and real estate markets because that reduces the wealth impact, it reduces speculation in the economy, it reduces a lot of the mania, and so far, the drop that we got so far in the stock market, and for that matter, the real estate market, the drops are not enough. They're just the beginning. Now, if you know another way we can defeat inflation without damaging the economy, please let us know. You might win the Nobel Prize in economics. But don't tell me that inflation is going to go down on its own because of some lag impacts. That's not going to happen. And if it does happen, and it pushes inflation down tremendously as you guys are pricing in, then it's going to happen for the wrong reasons. Because if the lag effects are going to impact inflation negatively in the months to come, then guess what? The lag effects will also impact the economy negatively in the months to come. You can't have your cake and eat it too. You can't say that the lag effects are going to impact inflation negatively, but somehow the lag effects are not going to do anything to the economy in terms of higher unemployment or slowing down the pace of economic activity. In other words, folks, there is no escape here. The market sooner or later will have to shift mentality from being excited by inflation going down to being fearful that inflation is going down for the wrong reasons. And the most important reason is the probability of a recession moving higher. And that is the reason behind inflation going down. At some point, the market is going to get it. The question becomes when. In the meantime, we have to cover the stock market activities today, and we begin with the closing of the indices, and here we go. The Dow Industrial Average closing in the green beat at the lows of the day with gains of 103.60 points or a gain of 0.30%. The Nasdaq closing in the green with gains of 113.08 points or a gain of 1.01%. Now this might look impressive on face value, but remember in the pre-market the Nasdaq was up by more than 4%. The S&P 500 also closing positive by 29.09 points or a gain of 0.73%. Now when we look at the sector performances today, the majority in the green, and the gains were led by energy at number 1, capturing the gold medal. And at number 2 for the silver, communication services, number 3 for the bronze, real estate. The theme is all over the place, but we're going to get the final adjustment after the FOMC tomorrow. On to the advance, the decline ratios. The NYSE 66% advancing versus 32% declining. The Nasdaq 54% advancing versus 43% declining. Now, while the equities market could not keep on the gains earlier in the session, guess who did? How about commodities? So you get excited about inflation going down, and guess what happens? Immediately, we see a rebound in inflation by commodities moving higher. And the difference is commodities did keep the gains. When we look at energy commodities, the WTI is up by almost 3%. Brent is up almost 3.25%. Gasoline RBOB up over 3.5%. Heating oil futures up by over 4% for the session. And the party boy, natural gas, continues to surge higher with gains of almost 6% for the day. When it comes to softs, we have gains led by cotton futures, moving higher by about 2.5%. Sugar futures also up by almost 1.75%. Coffee, cocoa, all closing in the green, while the laggards, led by lumber, down a little over 1%. Then OJ futures down almost 0.75%. Now the dollar was down today in reaction to the CPI, and therefore metals moved higher. Gold, silver, platinum, copper, palladium, all scoring gains, led by platinum, closing the day with gains of almost 3.5%. When it comes to meats, muted reactions by live and feeder cattle futures, beef closing in the green. And the leader, lean hogs, with gains of almost 1.4%. When it comes to grains, muted reactions for the most part, but we have gains, significant ones, for soybean oil futures worth about 3%. Soybeans are also up a little over 1.25%. And then the laggard in grains is wheat futures down about a little over 0.5 percentage point. But mind you, we could see a rally in wheat coming up because we have escalation in the war in Ukraine. And in this case, the U.S. is sending Patriot missiles to Ukraine, and the Russians don't like that. And the easiest way the Russians can escalate is to get out of the grains deal, which could end up pushing wheat futures higher again. On to the big casino, the options market. What do we see here? The volume is up for at least the top 3 names. Yet folks are not buying a lot of calls here. If anything, a lot of folks are buying puts to fade the rip, to hedge before JP speaks, who knows. But usually in sustainable rallies, we see the rally accompanied by a surge in volume in the options market, a lot of buying of calls. We're not seeing this right now. No wonder why the market flushed down when we saw a gap and crap. In any case, at number 1, the hottest table by far remains Tesla, the souffle, with around 2.8 million contracts traded today. Around 58% of those were calls. Now, a lot of you, by the way, misinterpreted what I said. Hey, Maverick, how are your calls doing in Tesla? Ha ha ha. I announced last Thursday that I'm closing my puts, and I bought calls for the day, for a rebound. And we got a massive rebound on Friday. Tesla was the outperformer. And I announced on Sunday that I closed all of my Tesla calls. It was a trade for the day, and that's that. And the long-term trend in Tesla remains to the downside. We talked about the head and shoulder formation on the monthly chart months ago. You think I'm now going to be bullish on Tesla? The hell is wrong with you? Anyways, Apple at number 2 with around 1.2 million contracts traded today. About 54% of those were puts. The moment I saw Apple blasting higher all the way to the no entry zone of 150, I did buy puts, and these puts, even just for today, if you bought them for today, they appreciated handsomely by the end of the day. And at number 3, Amazon with around 1 million contracts traded today. About 62.5% of those were calls. On to the unusual activities that took place in the options market today, and we start with the ticker SPY. We have a calendar put trade here. Somebody bought the 345 puts, and they sold the 330 puts, all for the expiration date of January 13th. With expectations that the SPY will go down and lose more than 14% of its value by then, but not more than 18%. They paid around 55 cents apiece for buying the 345 puts, and they received in credit about 35 cents apiece from selling the 330 puts. All in all, the entry cost is reduced to around 20 cents apiece, and that brings the total all the way to $650,000 spent on this trade. And then what about the ticker LAC, Lithium America? This name is beaten as of late. It used to be an outperformer earlier in the year. Now it's down year to date, but somebody sees a rebound coming. And they bought the 27.5 calls for the expiration date, February 17th, with expectations that LAC could score gains of more than 14% by then. And they paid around $1.50 a piece to enter this trade, all in all, spending around $900,000. And lastly, what about the trade for the ticker NFLX Netflix? Somebody's fading the rip here by buying puts, and I did the same. In this case, they bought the 300 puts for the expiration date, December 23rd, with expectations that Netflix could go down and lose more than 6% of its value by then. They paid around $2.80 a piece to enter this trade, all in all, spending around $875,000. On to the heat map analysis. What's going on here? It's starting to look a lot like Christmas, isn't it? We have some green, we have some red on the map. It used to be a lot of green, but by the end of the day, a lot of these gains went down. A lot of names lost the gains. But the notable take here is that we have gains being sustained in chips, in technology for the most part. The gains in energy stuck around all the way till the end of the day. But we saw a lot of weakness in healthcare, specifically in insurance names, and in the big pharma, Eli Lilly, of course, down about 2.25%. And I said stay away from Eli Lilly. Went too high, too fast. It needs to go down. And stick with Pfizer. Pfizer so far has been my best outperformer in the last couple of weeks or so. Now it's getting a little overbought, so we're anticipating another pullback in Pfizer. But this name remains a monster, at least for now. A lot of you say, hey Maverick, why did you add Pfizer to the portfolio? Aren't you aware that the jab revenue is down? I'm well aware of that, but remember, Pfizer made a buckload of money from this money laundering scheme. They made what they were supposed to make in 5 years. 5 years worth of profits they made in 1 year. Thank you to the money laundering operation by the government. Now Pfizer has a lot of excess cash in the books, and this alone will improve the valuation of Pfizer. Simple as that. And of course, the notable underperformers, the travel names, airlines are down because of JetBlue. We talked about that. But Tesla, oh boy, this name continues to underperform big time. Down yet another 4% for the day. Now, here's what I'm going to say about Tesla. Regardless of the reasons why the stock is going down, I believe it's a combination of a coordinated attack against Elon Musk. I believe that Elon himself is also dumping. That is reason number 2. So you got to stay away from this stock. It is a war zone. But is it going to experience a massive short covering rally at some point? The answer is yes. And if you want to play this, go ahead by buying way out of the money call options with the expiration date of, let's say, January or February. And if it plays out and we get a massive pop higher, these calls are going to appreciate. If not, you only lost the premiums. And in this channel, we did the same with Meta. By the way, we bought out of the money calls on Meta with the expiration date of February. The expectations were that at some point Zucchiniberg is going to capitulate and pivot from the metaverse fantasy. Well, this has yet to happen so far, but what happened is Meta announced mass layoffs, and that was good enough to induce a massive short covering rally. And these out of the money call options ended up appreciating in value handsomely. So what is the catalyst in Tesla for a short covering rally? The answer is if we have a new CEO at this point. If Elon steps away and allows a new CEO to take over, we will see a massive short covering rally in Tesla. But can you bet on that? The answer is no. When the forces of gravity say lower it goes. But if you want to roll the dice on this new CEO optimism short covering rally, then the only strategy you can use right now is buying out of the money call options with longer expiration dates. And by the way, while we continue to praise Elon Musk for his freedom of speech endeavors, we'll take him at his word for now at least, and we appreciate the fact that he released the Twitter files, etc., etc. It goes without saying that Elon Musk is still a scumbag, and of course he announced last year that he's going to donate $5.7 billion, and he's not a greedy billionaire, yada, yada, yada. Well, now we know that the $5.7 billion did not go to charity. It went to a charity, and this charity happens to be the Musk Foundation, of course. So this is yet another tax dodging scheme. It's not about being generous. It's not about helping people. It's not about being any of that. But hey, Elon, just like the rest of the oligarchs, they all have their own foundations and they dodge taxes that way. But the most important news for the day came from the big kahuna Apple. Remember, we talked about the iMob having the monopoly of the App Store, aka the racketeering revenue, aka the rent.
Came for the rent.
Or if you don't pay the rent to Apple, if you have an application on the App Store, if you don't pay the 30%, they'll shut you down. They'll crack your kneecaps. They'll ban you from the store. Well, not anymore, at least not in the European continent, because they passed regulations that what the iMob is doing is a racketeering operation. It's a monopoly. It's an illegal monopoly. And Apple is now forced to allow other developers to start their own app stores on iPhone devices. Or Apple devices, I should say. Now, when you cut down the racketeering revenue for Apple, whoops, all of a sudden the margins go down. And this is bound to happen here in the US, just a matter of time. So when folks say that Apple is the safest stock in the market right now, it is immune from the recession, from the inflation, from the whatever. What are you talking about? Because the most important growth story in this company in the last few years is about to end. You think this is good? And again, if Apple goes down, how do you think the market is going to do? With such massive weighting in the SPY and the Qs, news, the indices will go down too. Here's the heat map for the ETFs again. The majority in the green, despite the fact that the majority closed at the lows of the day. But the gains that managed to stick happened from energy, the XOP, XLE, OIH, all blasting higher. Even natural gas ETFs, UNG, BOIL, blasting higher. The gains in the XLK, for example, technology, faded right away. Yes, the XLK closed positive for the day, but way off the highs. Now, the notable reaction in international ETFs comes from the EWZ, down over 9% in a single day. A lot of political chaos in this country, so no wonder why the EWZ is down big. Now, this heat map is all over the place. Be it the majority of names are in the green, but Jerome Powell is going to sort it out. But until that happens, we have to move on to charts, so we begin with the SPY, the S&P 500 30 minutes chart. Insane overreaction, stupidity, massive pop higher, right off the gate, a massive gap that got us all the way to 410 in the SPY. Really? Before the FOMC is even out? What the hell are you people smoking? And by people, I mean the algos, of course. Because once the human beings saw this action, they looked at it as an opportunity to dump, to book profits, to book losses, and maybe to short. And immediately we got a massive flush down, and the chart lost 405 as support, consolidating by the end of the day in a bear flag pattern. And if we see this pattern playing out tomorrow in response to the FOMC, then the next destination would be closing the gap in or around the support of 398. But honestly, after the massive overreaction that took place today, Jerome Powell knows that if he comes out too dovish, or dovish at all, the market is going to blast higher again impulsively, and he wants to avoid that. So don't be surprised if Jerome Powell overdo it with the hawkishness. If he does that, I don't think 398 is going to hold. If he does that, I think we go down all the way back to home base at around 393.16 at a minimum. And here's the daily chart for the continuous contract for the S&P 500. Again, overreaction. It was not merited at all. Yes, it got us above 4,100 and everybody thought that we're out of the woods for a minute, and then came the flush down right away. It is not a textbook reversal yet, but the action is notable. Why didn't we see a follow-up? Why didn't folks buy right away, right off the gate? The answer is they're anxious about the FOMC, they're anxious about Jerome Powell, and most importantly, more market participants are now realizing that hey, a tick down in inflation doesn't matter, because what's going to matter most, at least as we head into the new year, is the probability of a recession. And if that moves higher, this is what the market is going to grapple with. Forget about a tick down in inflation, or even inflation moving down below 7%. If it's moving down for the wrong reasons, we're not going to rally. You look at the RSI, still in negative divergence, the MACD still showing negative momentum, and of course, the weekly closing becomes critical. If by the end of the week we have a closing above 4,100, the bulls win. On the other hand, if we have, by the end of the week, closing below 3,960, the bears are going to win. That would be the confirmation. We're going to go all the way down to the June bottom of 3,600 at a minimum. Look at the weekly chart for the SPX, the cash index. For a minute there, it appeared that we have a reflex that could be the equivalent of a reversal, because the chart made it above the sloping trending line of resistance, which was not merited at all. There was no reason for the SPX to trade above this, absent of a permission by Jerome Powell. So again, we got a confirmation that this chart is facing massive resistance by this line, as we should expect. And today we got yet another rejection, another confirmation that this chart needs something tangible, besides the tick down in the CPI, to pass above this sloping line of resistance. If the market doesn't come out with this evidence sooner than later, then we're going to see the SPX pulling back in a massive flush down, and this pattern of lower lows will continue. How about the Qs? 30 minutes chart. What's going on here? Again, overreaction, a massive pop higher. Believe it or not, it got us above 294. Absolute delusion, and it was a gift for the bears right away. And if you placed the short in the morning, the Qs lost 294.33 as support. Not only that, it lost 290, and then it went down to the support of the top of the breakdown candle and managed to keep that as support by the end of the day, yet forming a bear flag pattern. And if this pattern plays out because Jerome Powell or whatever reason, down we go to closing the gap, and after that we have support at 284.26, but in all likelihood that's not going to hold, and we go down to home base of 280 at a minimum. And here's the daily chart for the continuous contract for the Nasdaq. Again, overreaction. Yes, it got us above the number, the most important number, 12,207, but couldn't close above it by the end of the day. So therefore, we're back within range. Nothing changed here. But the weekly closing becomes really, really important. Closing above 12,207 will firm the case for an end of the year rally, Santa Claus rally, whatever you want to call it, and the bulls win. But the most probable outcome right now is that by the end of the week, the chart loses 11,689, and that would be a confirmation that the bears are going to win. We will see the June bottom revisited. We will see a retest, and this retest will be met by failure, and we will see the market making lower lows. What about the IWM, the Russell 2000? Again, the gap and crap got us above 183, not quite, to 188, but then came the flush down. It lost 183 as support. It closed the gap, got a little rebound, but again forming a bear flag pattern. And if the bear flag plays out, down we go to 174.22. What about the Dixie, the dollar index, a daily chart? What's going on here? We were looking for an ABC pattern. I believe that today's action was an overreaction, a knee-jerk reaction, and the ABC pattern will play out either way. And the reason is because Jerome Powell wants the dollar to stay higher. Because remember, a higher dollar is restrictive. When the dollar goes higher, it is the equivalent of monetary tightening. Now, Jerome Powell doesn't want to see perhaps new highs in the dollar, but he wants to stop the bleeding. He wants the dollar to consolidate at a higher level, which is considered to be restrictive to eat away that inflation from the economy. And again, the technicals are supporting higher dollar, a rebound for now. You look at the RSI, the MACD indicators, they're just waiting and waiting for the catalyst to come out. And I believe we could see the catalyst coming out as soon as tomorrow by Jerome Powell, and we get the pop in the dollar. If that is the case, gold will go down. We will see this bear flag pattern playing out, and it will lose the support of 1,763. Now, of course, if Jerome Powell comes out dovish for whatever reason, it goes without saying that the opposite will happen. Gold will pop higher, dollar will go down, equities will rebound higher again. But why would Jerome Powell be dovish at this point? There is no reason for him to be dovish at all when the market is pricing in interest rate cuts. If anything, he's motivated to become even more hawkish tomorrow. How about UK oil, Brent? A weekly chart, we have a rebound from the Fibonacci support at around 77 for now. And the question becomes, is this a dead cat bounce or a legit sustainable rally? Well, if it wants to become a rebound in a sustainable way, we have to see a lot of repair happening in this chart. What am I talking about? I'm talking about the MACD indicator, for example, from a weekly chart perspective. We have to see a reversal. We have to see it crossing, producing green impressions in the histogram again before we say, okay, we're out of the woods. Oil managed to find the bottom here. Otherwise, these rebounds are not going to last. Next, what about the 10-year yield? What's going on here? Initially, it went down. We saw the CPI euphoria happening. But then the chart managed to climb higher, above 3.5, and I believe it managed to close in or around 3.5 by the end of the day. In other words, no confirmation that the 10-year lost 3.5 for good. We would have gotten that confirmation if the chart made a lower low, but instead the chart made a higher low, indicating that perhaps when Jerome Powell comes out tomorrow, he's going to come out hawkish and we see the 10-year moving higher. And if that is the case, look at the daily chart for the TLT. We've been saying, folks, it is becoming a little overbought at this point. You have stiff resistance at around 109.5. Why not book some profits here, wait for a legit pullback, and then hop in again and buy the TLT. How about the VIX 4 hours chart? What's going on here? We talked about closing the gap. It has to be closed right away, and this is exactly what happened. But I also said in reading the tea leaves, will the VIX go down, close the gap because we have overexcitement for the CPI, and then comes JP with the hammer, and we see the VIX bouncing higher again, forming perhaps an ABC pattern. We'll see what happens. How about Apple 30 minutes chart? Again, a pop higher. Insanity all the way to the no entry zone. Now, this is a no-brainer. Every time Apple got to the 150, the no entry zone, it got smacked down. AKA, every time you see Apple at 150, that is a signal to short and buy some puts. Until Apple comes to 150 with a piece of evidence, Apple must show the credentials before moving above 150 again. For now, we have no fundamental reason for Apple to trade above 150 at all. So when I saw Apple at 150, I bought puts right away, and these puts doubled in value today alone. So I had to book the gains and get out. Wait for Jerome Powell. If he comes out hawkish again, then double down, and down it goes. The bear flag in Apple will play out, and at least the chart will go down all the way to the trend line. If that is broken, we go down to 138.79. Now, what about Tesla? And we're using a daily chart here. Look at this. We have a series of lower highs and lower lows, and there's plenty of room for the RSI, for the MACD, to move the chart even lower. So we're now looking for 130.77 as the next support, and if we zoom in to a 45 minutes chart, what do we see here? Is this a formation of a head and shoulder pattern combined with a reverse ABC pattern. If that is the case, then in no time we will see Tesla all the way down to the next support at around 130.77. And lastly, tulips. Bitcoin, a daily chart, we're seeing the bull flag finally playing out, but amid some resistance here at around 18,000. For now, the indicators say that Bitcoin could move higher. This could be overexcitement regarding the news of the arrest of Sam Bankrupt fraud, but if it is not an overreaction, we could see it playing out all the way to 20,000. If it is an overreaction, and the Fed is going to put an end to this, because here's the other thing. We talked about the Fed wanting to see higher unemployment. Of course, they're not going to come out publicly and say that. We talked about the Fed wanting to see more damage in the equities and real estate markets. But guess where else the Fed wants to see damage? How about the crypto market? How about the tulip market? The Fed wants to see Bitcoin down. So don't be surprised if we see Bitcoin moving down again if Jerome Powell comes out with the hawkish tone. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the import price index, but the most important event is the FOMC and the subsequent conference by Jerome Powell. And it goes without saying that all eyes will be on JP and every single word he says. We're going to cover all of it live. But with that, ladies and gentlemen, we're done here. This is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow.
What'd you say? Are you being a f***ing wise guy with me? Huh? What did I tell you? What did I tell you? What did I tell you? You don't buy anything, you hear me? Don't buy anything.
Sorry.